Hello, welcome all. This is Abhilash. In this session, I'm going to cover insurance products which is offered under the asset-based finance services, and we have mutual funds as well. So these are the asset-based financial services. So let's start with the insurance sectors. So due to COVID, you might have heard many things about the insurance, right? Health insurance. Okay. So definition of the health insurance is a legal contract between two parties whereby one party called insurer undertakes to pay a fixed amount of money on the happening of a particular event which may be certain or uncertain. The other party called insured pays in exchange of fixed sum called a premium. So insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against the losses from an insurance company. The company pulls clients' risks to make payment before affordable for insured. Insurance policies are used to hedge against the risks of financial losses, both big and small, that may result from damage to their insured or her property, from liability for damage or injury caused to the third party. Okay, so these are the type of insurance: general insurance and life insurance. Okay, so general insurance offering the fire insurance, marine insurance, and medical. Okay, so general insurance are those insurance where you will not get the money return. You have to pay the premium. Against the premium you will receive the some assured money once uncertain or certain event happen in your life. Okay, so fire insurance means for the particular 11 month or 12 month you will get the fire insurance for yourself, for your property, for your car, where within the period of time if some damage happen to the property you will receive the some assured money. Same is with the marine insurance, and same is with the medical. Here 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 you will not get the premium returns. See, this is the one time investment. But now what Indian people thinks about this insurance, they are think that the things that these are the dead investment, but this is the not a dead investment. Why? Because if certain uncertainty happen in your life you will get the some assured amount, right? It will help you to get over 100 of the time, right? So this is how people are thinking. Again, one more thing: motor vehicle, against the motor as well you will not receive your premium back, but on the yearly basis you have to pay the premium which will cover the damage of your car, damage of your vehicle, damage of your bike as well. Okay, the second is life insurance. The life insurance is the insurance where you will get the premium back, right? And life insurance, once the insurer person's dead, he will receive the sum assured amount. He will not, his family will receive the sum assured amount with the some interest as the as which is mentioned in the life insurance product. Okay, so there is two different segments: general insurance and life insurance. In the general insurance you will not receive the premium, but in life insurance you will receive the premium back if you didn't uh, go for the claim. Okay, so in the general insurance if you didn't go for the claim within the period of time, your insurance policy will lapse and you have to renew again by making the next premium payment. Okay, so origin and the growth of insurance sector. Insurance, till the end of 99 2000, the two state-run insurance companies, Life Insurance Corporation and General Insurance Corporation, LIC and GIC, were the monopoly insurance providers in India. Under GIC, there were four subsidiaries: National Insurance Company, Oriental Insurance Company Limited, then New India Insurance Company, and we have a United India Insurance Company as well. So under the GIC, so there were a monopoly in insurance company. Nowadays we have foreign companies as well: Max Bupa, Niva Bupa, then HDFC Life, right? So there are many companies. Again, we have a Star Health for Mediclaim. So These are the national insurance companies: the Oriental Insurance Company, then New India, then United India. Okay, in fiscal policy of 2000 to 2001, the Indian federal government lifted all entry restriction for private sector investors. For investors, insurance market was also allowed with the 26% cap. GIC, General Insurance Companies, was converted into India's national reinsurer from December 2000. All the subsidiaries working under the GIC umbrella were restructured as independent insurance companies. IRDA. So IRDA is a insurance regulatory and development authority, is an autonomous apex statutory body which regulates and develops the insurance industry in India. IRDA batted for the hike in the foreign direct investment limited to 49% in the insurance sector from the erstwhile 26%. The FDI limit in the insurance sector was raised to 49% from 26% in July 2013. So, insurance is a contract in which an insurance indemnifies another against losses from specific contingents. There are many types of insurance policy: life, health, auto, car, general are the most common form of insurance. The core components that make up the most insurance policies are the deductible, policy limit, and premium. The next is mutual fund services. A mutual fund is pool of money from numerous investors who wish to save or make money. Investing in a mutual fund can be a lot easier than buying and selling individual stocks and bonds on your own. Investor can sell their shares when they want. Mutual fund services delivers a broad range of innovative transactional or information services to automate, standardize, and centralize process to create efficiencies and reduce cost and risk for mutual fund marketplace. Mutual fund solutions driving business relationship between the asset managers and their distributors, linking a vast network including fund companies, investor managers, brokers, dealers, banks, trusts, and other financial services firms that offer fund investment to the market. Professional management. Each fund's investment are chosen and monitored by qualified professional who use this money to create a portfolio. Fund ownership. As an investor, you own shares of mutual fund, not the individual securities. All shareholders share in the fund's gains and losses on an equal basis, proportionally to the amount they have invested. Mutual fund money. There are seven common types of the mutual funds. We will discuss later. So mutual funds are diversified. By investing in mutual funds, you could diversify your portfolio across a large number of securities so as to minimize risks by spreading your money over numerous securities, which is what a mutual fund does. You need not worry about the fluctuation of the individual securities in fund's portfolio. So there are seven types of uh, mutual funds. The mutual fund schemes are segregated into two heads. Before that, we have a two heads to discuss the schemes according to the maturity period. Open-ended funds. Open-ended schemes are those schemes where investor can redeem and buy new units all through the year as per their availability. The close-ended fund and scheme. The fund is open for subscription only during a specified period. At the time of the launch of the scheme, investor can invest in the scheme at the time of the initial public issue, and thereafter they can buy and sell the units of the scheme on the stock exchange where the units are listed. Second, schemes according to investment objective, growth equity oriented schemes. So there are many schemes available. Like we like one can go for the large cap. We have option like we have another option as well. Large cap, mid cap, small caps, growth oriented, equity oriented, debt oriented, balance fund, money market funds. So there are many schemes available while investing in mutual funds. Money market mutual funds are low risk funds, offers highest possible current income, consistent with the preservation of capital. So regulation and distribution. So we have a AMFI, as we have discussed IRDA in insurance product. So we have a AMFI, that is the Association of Mutual Funds of India is a self-governing association of Indian mutual funds that regulates its member sales, distribution, and the communication practices. Investors can invest in Indian mutual funds directly or through distributors under codes of practice developed by AMFI, Association of Mutual Funds of India. So our mutual funds in India today are regulated by SEBI. So there are seven common types of mutual funds: money market funds, fixed income funds, equity funds, balance funds, index funds, passive fixed funds, and funds of funds. So which is just differs by the growth equity oriented scheme, income scheme, debit scheme, balance funds. Okay, so we are done with the insurance products and mutual fund products which is offered under the asset based financial services. Thank you. Best wishes.